Welcome to Sifter Fund's annual review. The Sifter Fund share price increased by 34.4% during the year, which is the best year in the history. This return exceeded the global stock index MSCI by 6.8%, meaning that fund provided a significant excess return. The institutional class, so-called PI class, rose even more by 34.8%, beating the market index by as much as 7.3%. All in all, an excellent year for the investors and the fund. In this presentation, we will cover 4 topics: fund returns, top and bottom performance in the fund, portfolio changes during the year, so what we bought and sold, and finally, Sifter portfolio business metrics in the end of last year. Next, let's look at the top and bottom performers in a fund among Sifter 30 companies. The biggest gains in stock prices were seen in old Domimion Frightline, Alphabet, and Novo Nordisk. Respectively, the biggest declines were seen in Nitori Holdings, Koita Manufacturing, and Safran. In this presentation, we have involved Sifter portfolio analysis team members Mr. Carl Litzel, Alexander Järv, and Olli Pöyhönen. At Sifter, Old Dominion company is covered by Carl Litz. The company is certainly quite unknown to many. Could you tell Carl what the Old Dominion does?
So, Old Dominion is a trucking company that is a pure-play less-than-truckload carrier. It essentially means that instead of moving a customer's goods from location A to B, it uses a hub-and-spoke model of terminals and moves multiple customers' goods in its trucks. Sounds simple enough, but what makes Old Dominion special and why has its share price risen almost 100% last year? In short, Old Dominion has 3 interconnected advantages that makes it by far the most profitable player. First of all, its unparalleled service quality allows it to charge a small premium. Second, thanks to its superior profitability, it has been able to heavily invest and expand its business through economic cycles. And third, its dense network of customers and continuous internal efficiency improvements has further boosted asset utilization and margins. The short answer then to why the price has risen so heavily is because there has been a strong shortage of quality less-than-truckload capacity in the US, and Old Dominion has been perfectly positioned for this surge. So, if you're wondering whether we still see Old Dominion as a good investment, I can say that the long-term underlying growth factors, like chronic shortage in qualified truck drivers, revitalization of US industrial economy, and the proliferation of e-commerce distribution centers are fully intact. And what I personally like most about Old Dominion is that it is doing the same thing today that it has done for decades, and it obviously works very well. Therefore, I doubt Old Dominion's management will fix something that's not broken. Another big mover this year has been the Danish company Novo Nordisk. This might be a familiar name to many of us, but can you, Alexander, tell us what does this company do?
Novo Nordisk is a Danish pharmaceutical company with a leading market position in diabetes care. The company manufactures and sells different kinds of insulin, both rapid insulins and also basal insulins, and in addition other kinds of drugs for treatment and management of diabetes. And perhaps the most important of these is the new kind of GLP-1 analog drugs called semaglutide, which has been quite a blockbuster drug for Novo Nordisk in the last 3 years. So why has the share price of this stock increased so much lately? Over a period of the last 3 years, the share price has increased by an annualized rate of 30% per year. And in last year alone, the share price increased by 72%. Now the biggest reason for this has been the success of the company's latest drug, the aforementioned semaglutide drug. This is not an insulin per se, but is a drug that is very beneficial for managing type 2 diabetes. And the sales of this drug has been very good. For example, last year revenues grew by 30% from this one drug alone, and it now makes up over 45% of the revenue for the entire company. In addition, it was found that one big side effect of this drug is that it caused a significant reduction in body weight among its users. And based on this fact, the company undertook a large clinical study, and in June of 2021, last year, this was approved by the FDA in the US for use in obesity treatment. And after this, the drug saw tremendous success in the market. It both surprised the company's own management and the stock market alike. In fact, this is the first obesity drug in the world that actually works quite well with only limited side effects. And this has caused a lot of optimism in the share price. So what is our current view on this company? Well, the outlook for this company is now better than ever. As we all know, diabetes and obesity is a large and growing problem in the world. The outlook for Novo Nordisk traditional insulin products remains good, but we see the big upside from this new semaglutide drug and its application both in diabetes care and for the treatment of obesity. And in our view, Novo Nordisk is still a very high quality company, and we still intend to be invested in this company over the long term. But the last year has not rewarded all of our investments in the same way. There were a few companies that affected the fund's performance negatively, of which 2 were Japanese and 1 was a French company. One of the Japanese companies with negative performance is Nitori Holdings, also sometimes called the IKEA of Japan, which we invested into March of 2021. Now, Olli, can you tell us more about this company and why we still believe in Nitori, even though the market has not yet rewarded this stock?
Thank you, Alexander. Nitori operates in the furniture and home fashion industry, primarily in Japan. Now, the industry faced headwinds during the year, and it's not clear how soon these challenges will pass, and Nitori is now on our watch list. The industry's outlook was shadowed by high raw material prices and persistent logistical issues, which increased margin pressure across the industry. Now, due to these challenges, for example, IKEA announced in December that it will hike prices on average by 9% globally. And in Japan, the depreciating yen has added to these pressures. So far, Nitori's financial performance has largely matched our expectations. And this is because our forecasts for Nitori's current and next fiscal year have been conservative relative to the market consensus. Based on our original forecasts, which extend 5 years into the future, Nitori still offers good long-term return potential, assuming that the industry conditions eventually normalize. Now, why do we think that Nitori has good long-term potential? Well, first of all, Nitori has a good track record of profitable growth. The company has increased its revenue and profits every year over the past 3 decades. And Nitori's share of the Japanese home fashion market has increased at a stable pace. The company has also reported industry-leading margins and returns on invested capital. Now, secondly, Nitori has at least 2 key sources of competitive advantage: vertical integration and an extensive store network. Nitori has taken this integration particularly far as the company operates its own factories in Vietnam and Indonesia. And this level of integration is not possible for all market players. And in addition to the efficiency gains and coordination advantages that this integration offers, it should also allow Nitori to tackle the industry's current supply chain issues more efficiently than its smaller rivals. Nitori also has over 600 stores in Japan, while IKEA, for example, only has 13. We believe that the store network is an advantage, particularly in furniture retail, as customers would probably prefer to see and feel the products in store before ordering them. Finally, we also believe that Nitori still has room to grow in Japan. While Nitori already has about 20% share in the Japanese home fashion market, the company's share is actually closer to 10% if we also include the markets for household durable goods or the markets for household repair and maintenance tools and materials. And in recent years, Nitori has expanded its product offering towards these broader categories. For example, Nitori has recently introduced large private brand home appliances such as air conditioners to its selection of products. And in 2020, Nitori acquired another retailer called Shimachu, whose product offering includes hardware store items. Another underperformer in 2021 was a French manufacturer of aircraft engines called Safran. Now, Safran has been a part of the Sifter portfolio since 2015. Carl, can you tell me why Sifter originally invested in Safran?
So, the third detractor of 2021 was the French aircraft engine manufacturer Safran. We initially invested in this company because it embodied the quality characteristics such as high barriers to entry and predictably growing earnings. Its future business is secured by a decade or so long backlog of aircrafts to be produced by Airbus and Boeing, and the steady sales of spare parts to engines currently in service. We still see Safran's competitive position as strong, thanks to its excellent family of LEAP engines for narrow-body planes, and still see that entering this industry is immensely challenging. It does not take a rocket scientist to deduce why Safran's share price hasn't performed this year. COVID lockdowns greatly hindered air travel, and with it the sale of spare parts and forced aircraft manufacturers to slow down or halt production temporarily. As time progressed in 2021, it became more apparent that double vaccination would not be a panacea for civil aviation. With that said, we still believe in Safran as an investment, and did, in fact, slightly increase our position in it. This is because our initial reasons for investing are intact, and because of Safran's operative and financial strength, we see the question of when, not if, Safran's earnings will return and exceed the 2019 levels. And we believe that the worst is behind us.
So, here we have the biggest winners and losers in the portfolio over the past year. Next, let's look at what changes we made to the portfolio over the past year. The key idea of the Sifter investment philosophy is to identify high-quality companies around the world, research them closely, and own them for a long time. Because of this, we rarely make purchases and sales in the portfolio. During the year, we investigated over 54 companies, but ended up investing only in 2 new businesses. Correspondingly, we increased our weight in the current positions for 5 existing portfolio companies. When we buy something new, we sell something out of the portfolio, according to agreed criteria. We completely divested 3 companies, Sony Holdings, Oracle, and iRobot, and reduce weight in 3 other companies. In this way, we aim to improve the content of Sifter portfolio while keeping the portfolio fresh and evergreen. Let's look at the new companies we bought and how they have performed during the year. We will start with Sony.
Sony Group is our latest investment, which is comprised of 6 business units. As explored in more detail in an earlier video, we particularly like Sony's positioning in the console gaming industry, music industry, and the image sensor industry. We like the strong competitive positioning in these growing and often oligopolistic markets, and after applying conservative estimates on Sony's future prospects, we realized we would still achieve a good yield on the investment. The share price evolution of Sony has been favorable for us, even in the short term. As Sony is a diverse business, there is no single factor which explains the short-term overperformance. Some highlights, however, are that the PlayStation 5 is continuing to sell very well, and music streaming is booming. Sony Pictures Networks India has also announced a merger to strengthen its position in the growing linear TV market in India. And finally, Sony's semiconductor business announced a joint venture plan with the world-leading logic chip manufacturer TSMC. In other words, all business units are performing at least as good as expected. So next, we will explore the companies which we have sold during the prior year. First up is iRobot, which we owned less than a year. So, Alexander, why did we divest iRobot within a year of investment?
Okay, so first a little bit of background on the company. iRobot is an American robotic vacuum cleaner manufacturer, mostly known for its Roomba brand of robots. This is a company we first invested into in April of 2020, and we did this for three main reasons. Firstly, the company has a strong market position with a global market share of over 50%, and this is due to its strong brand and large patent portfolio. Secondly, the total market for robotic vacuum cleaners is growing very fast at this moment, and the demand is currently growing at double digits per year. And thirdly, at the time invested, the stock was very attractively priced, especially compared to other comparable investments. This investment therefore matched our investment criteria very well, and the share price performance exceeded markets during our first year of investment. However, at the start of last year, something very interesting happened on the stock markets. So in January of 2021, there was a few interesting movements in stocks that were heavily shorted. And the most highlighted stock in the media was the US company called GameStop. This saw a tremendous short squeeze in January, where the share price went up multiple hundreds of %. Another less well-known stock with a similar phenomenon in January was iRobot. This company had at the time 30% of its shares sold short. And like GameStop, this also saw a similar massive increase in share price over a few days. This was without any clear fundamental reasons. We therefore decided to sell all of our shares in iRobot at an 235% profit. And we put this cash for better use in our other Sifter companies. And this was for us a very unusual short-term investment of just under 1 year. Usually our holding period is around 5 years or more. One such example is Oracle, which we recently sold after 9 years in the portfolio. Olli, can you tell us more about Oracle?
Oracle is a good example of our willingness to stay invested in companies that have strong earnings models. Oracle is a software company that generates about 3/4 of its revenue from recurring services that it offers to corporates and governments. These services are mainly linked to critical functions such as databases and enterprise resource planning systems. The customers are hesitant to cut corners when it comes to these systems, and switching from one software provider to the other is typically a lengthy and risky process. And all those characteristics are reflected on Oracle's financials. Earnings are stable and margins are high. Unfortunately, we had to eventually divest Oracle because despite a good earnings model, the company was not heading in the right direction in terms of both competitive position and leverage. Oracle's growth lagged behind competitors for years, and this was particularly true in Oracle's database business, where Oracle's competitors were much more successful in leveraging the shift towards cloud computing. And in the last 2 years, Oracle's leverage increased rapidly, driven by debt-financed share repurchases. And at the time of sale, Oracle was actually one of the highest levered companies in the Sifter portfolio. Now, let's take a look at one more company which we sold after being invested in it for a long time. This company is called Sony Holdings. It's from Japan, and it was part of the Sifter portfolio for almost 5 years. However, the share price never really took off. Carl, can you tell us why we eventually sold this company?
So, Sony Holdings is the largest dispensing pharmacy chain operating in Japan. We initially invested because the market was experiencing a consolidation wave, and we saw Sony Holdings as being well positioned to continue to grow, mainly through acquiring independent shops and small chains. We started scrutinizing the company when management decided to shift their strategy to instead focus on opening pharmacies on hospital property. This was contrary to our initial investment hypothesis, and the results were not up to our expectations. The corona crisis, however, presented us with a clear opportunity. As a pharmacy chain, the company was deemed to be a defensive stock and did not suffer as much as the wider market. We thus saw and took the opportunity to start redeploying the capital for better use cases.
Investing in equities is forward-looking in nature, and we would be all eager to know what the future or even next year will look like for an equity investor. There has been a lot of discussion in the media recently as to whether stock market is facing a new rise again or whether there will be some kind of correction this year. Instead of trying to guess how stock prices are evolving or which industries are in favor, we put all our efforts researching the quality of our businesses. When we look at how the business indicators of the following companies in Sifter portfolio have developed, we get pretty good assurance how we believe they will continue to do in the coming years. For example, when we look at the sales growth of Sifter companies, we get an idea how the business could evolve in the coming years. Naturally, every company is different and their earnings models need to follow company-specific growth metrics. However, we can see that 13% increase in sales compared to the last year was the best in the 5 years. We don't want to invest in a company just because of its growth. At least as important as growth is monitoring company's cash flow or operating profit margin. At the end of the year, the median operating profit margin for Sifter companies was 27%, which is very high and clearly higher than the corresponding figure for S&P 500 companies. So we know our companies are excellent money-making machines. One measure of future profitability is return on invested capital, or ROIC. It tells you what kind of return a company gets when it invests in its own business, for example, in a new products or opening new markets. The management of Sifter companies has constantly found profitable investments and received as much as 20% return on invested capital last year. This is one reason why we prefer companies that invest in growth rather than distribute money as dividends to owners. We prefer debt-free companies and consider indebtedness as one characteristic of a healthy, high-quality business. Even though the price of money, or interest rate, so to say, is currently very cheap, we still value cash-rich companies. Sifter companies are, on average, cash-rich with a negative 0.3 EBITDA ratio relative to net debt. The same cannot be said of S&P 500 companies with a median debt of 1.8 times annual EBITDA. The last point in monitoring the portfolio, of course, is the valuation. In other words, whether the companies in our portfolio are too expensive or not. To measure valuation, we use a metric that compares enterprise value to EBITDA. At the end of the year, it was 19.5 times, and it is slightly more expensive than the median S&P 500 company. Whether this is expensive or cheap depends on several aspects. The median of the 30 companies in Sifter portfolio is slightly more expensive, largely because their business metrics are at an excellent level and they are very, very healthy companies. Over a long period of time, more than 5 years, high-quality companies have surprised investors with their earnings and therefore their share prices have continued to rise. Finally, I would like to thank our investors for their trust in us. Not all years are that good as the previous one, but in the long run, investing in quality companies has paid off. In addition, investing in quality stocks has brought peace of mind to many of us, which is a relatively important issue in a world where concerns seems sufficient. Thank you and have a great year.